And Thursday the 12th was the day we've all been waiting for. MBS were up 8 basis points early this morning. It actually improved 10 basis points while I was writing my morning post. The 10-year was down 7 basis points early. Bonds were lower in the overnight session. Traders were clearly expecting a whisper number, as it's called, that was lower than the median forecast. Simply by coming in as expected, CPI managed to disappoint the market somehow. This also ups the odds of a bounce back after the initial leg of selling. Monthly headline CPI came in at minus 0.1 on an expectation of being flat. It was 0.1 previously. Core CPI came in at 0.3 on a 0.3 forecast. It was 0.3 previously. The news this morning was the CPI data released. It first appeared that someone had early data or something with the market rallying ahead of the release, but then the data came in right on the screws. Pretty much every reading matched Bloomberg's survey estimate. There has been some healthy chatter in the morning in Chris Maloney's anonymous Bloomberg chat following the release. The market is pretty messed up, and there's a lot of uncertainty about how the Fed will handle the rate raise going forward. If you take the last two readings of CPI and extrapolate it out for the next 12 months, the run rate would come in at 1.6% on the headline, and the core would be 3%, though that would still be increasing prices along the way and establishing very high levels without deflation, which is really bad. They would just permanently stay high. Energy fell 4.5% month over month. Gas fell 9% and is down 15% year over year. Food climbed 0.3 month over month, is up 10.4% year over year. Yesterday's 10-year Treasury auction was pretty good. Today's bond auction 30-year came in at 3.585 versus a 3.610 forecast. Bid to cover was 2.45 versus a 2.36 average. Bonds were already rallying in the past 3 hours before the auction, but the auction results were kicking things into especially high gear. You won't see too many days with a 10 basis points plus rally in response to an economic report coming in right in line with expectations. That's pretty much what we had today. Wall Street looked past its initial disappointment with just an in-line consumer estimate to focus on the idea that an inflation peak is possibly in the rear view. That perception is visible in the swap market, which is showing less than 50 basis points of tightening priced into the next two Fed gatherings. A small chance of no move in March. None of that means, of course, the Fed will follow this and do what the markets think. At the end of the day, we were up 31 basis points, ending up at 101.70, and the 10-year Treasury came in at 3.444, being down 11 basis points. That reading of 101.7 puts us right up there, just above that Fibonacci 38% retracement line at 101.67, which is this brand new range. We have a lot of support underneath, so we'll see if it continues into that range tomorrow or if it flattens out and people will do some selling because they want to make the money they made today. And we also got a second post from our sponsor at WellThatMakesSense.com. This is from the book Traction. So hopefully you've set your goals for this year, and if you want to come up with a plan to make it happen, not just have it be something written on a board on a wall, and actually have plans to get it done, Traction is your operating system. So check that out on WellThatMakesSense.com.